Chandran, please take it away.
Ali, thank you very much, and certainly we're delighted to have an opportunity here to share with the many participants that are dialed in and talk about a topic that in many respects is near and dear to all our hearts. To really jump right in, we start with this graphic of a picture is worth 1,000 words. And the reason we really wanted to just start with a picture to set our mindset to what we really want to set in motion as we talk about our topic today. Inflation really is a constant concern. And certainly there are many pressing concerns in the marketplace today as we think about how we work with investors, and certainly how all the participants on the call think about how they advise investors. But whether we go through periods like we've seen even somewhat recently where there are deflationary concerns, again, we try and take a long-term or strategic approach and keep in mind that inflation is really one of those core long-term risks that gets at the health of an overall investment portfolio. Sometimes when we're in our shop, we joke around and we talk about sort of what we call convenient and inconvenient truths. And so certainly as investors ourselves, as for many of us advisors for individuals and institutions who are working with investment portfolios, we certainly understand the impact of inflation on the purchasing power of a portfolio, and those are the realities that we think at the forefront of our mind and sometimes at the back of our mind when we're thinking about that. There is a lot of talk today in terms of the Federal Reserve's role, in terms of their ability to manage both inflation and expectations around that. And we settle into a view, at least from a high-level strategy standpoint, that the Fed certainly will and has tolerated periods of higher inflation in pursuit of economic recovery, and we think that will continue to be the disposition for some period of time, particularly given the cross currents in the market today. That being said, one of the things that we really want to point out and sort of will drive home during the course of this presentation is that not all inflation hedges are created equal. So whether you're thinking explicitly about it or it's somewhere on the back burner, I think that when we look at some of whether it's the asset classes or the vehicles that investors think about, I think that'll be very important. The other thing that I would note is we really think long and hard about what's the approach to looking at or hedging inflation over the course of a long period of time. So we look at hedging inflation over very different time horizons and thinking about very different risk horizons. The next thing we want to just use to set up our thoughts in terms of talking about inflation is just a little bit of what we call food for thought. And so, again, when we think about inflation, it's certainly one of those risks that, while very commonly understood, it can be certainly hazardous, especially if you get into periods where there's unanticipated or unexpected inflation. So specifically what we want to do is explore several questions that I think we deal with regularly. Many of you who are participating in this call might think about as you think about investing and advising people on their portfolios. The first thing that we ask is why several asset classes that are touted to be strong hedges for inflation, why in reality they may turn out to be less favorable than people think or have surmised. And I think that's an important question to ask and answer. We also, one of the things that we found fairly common is that while Treasury inflation-protected securities are commonly referred to, used, and thought of as inflation hedges, people commonly fail to account for the duration risk associated with those. So we want to spend a little time talking about why that's the case and maybe how people ought to think about that. The next thing that we sort of want to ask and answer is, how do differences in how inflation is measured impact how you help people manage their overall investment portfolio, especially when you're looking across various asset classes? Now, this may seem like semantics, but hopefully you'll find as we dig into this a little bit that measurement and the application of that matters a great deal. We believe at the conclusion of the time that we spent together that, one, we will at least offer up for consideration a framework for thinking about inflation hedging over 3 discrete periods: the short term, the intermediate term, and the long term. We also believe that we can offer a perspective on the use of TIP securities in an investment portfolio that might coincide with some of the thoughts that others have or how you utilize them, or may even offer a slightly different perspective. And then finally, we'd like to talk a bit about the potential benefits of specifically employing natural resources with respect to inflation hedging. And we think about accessing those natural resources through public equity securities. With that in mind, I'd like to take this opportunity to turn it over to my esteemed colleague, Mark Carlson, to take us through some thoughts.
Thank you, Chandra, and let me add my thanks to Ali and to Index Universe and to all of you for taking the time out of your day to participate in this discussion about inflation. To start our discussion this afternoon, let us take a look back at the history of inflation in the U.S. over the past century, because we study history in order to learn from successes and mistakes. The chart you're seeing depicts annual inflation rates of CPI dating back to 1915 as published by the Bureau of Labor Statistics. Let us view this data with some grains of salt, understanding that the way CPI is calculated has been modified numerous times, including the all-important 1983 substitution of owner's equivalent rent for housing prices, and the understanding that CPI does not represent all investors' beliefs as to how inflation should be measured. However, we must play the cards that we are dealt. We see from this data is the economy experienced several volatile periods of inflation and deflation. It is also interesting to view this data understanding that the Federal Reserve, with its dual mandate of promoting full employment and price stability, was created in December 1913. So this is a history that covers the period in which the world's most powerful central bank has been in existence and charged with promoting price stability. Take special note of the inflation price stability following the 1970s oil and COLA, or the cost of living adjustments, and labor contracts induced inflation. So let's take a closer look at that period. Here is the U.S. inflation data from 1979 through 2011. This represents the period that includes the October 1979 Saturday Night Massacre by Paul Volcker and the Federal Reserve, where the Fed funds rate was allowed to find its own level to address the high level of inflation being experienced in the U.S. during the late 1970s. At that same time, a very important economic data series was developed by the University of Michigan, the Survey of Inflation Expectations. This became important because consumer, corporate, and investor expectations of inflation would become an even more important part of modern economic theory in fashioning economic, monetary, and fiscal policies. The inflation data shows that following the late 1970s inflation and early 1980s recession, inflation has been fairly well managed, except in 1990 due to the Iraq War leading energy prices higher, and in 2009 being the post-financial crisis deflationary period. There are several reasons behind the well-behaved inflation data. Some of it is due to measurement calculations, but much of it has been the result of structural changes in the U.S. economy, such as declining indexing of compensation to inflation, transition to a service economy, globalization, technology, and overall increases in productivity. As an example, think about the difference of the economies of the 1970s to the 2010s. One of the largest companies in the U.S. in 1972 was General Motors. Today, in 2012, it's Apple Computers. Think about the compensation structure differences between GM in the 1970s versus Apple of today, with the prospects for structural wage inflation. The movement toward non-wages-based compensation has diminished the flow-through of wage increases into inflationary pressures. One of the key takeaways from this chart is evidence that the Fed's ability to manage inflation expectations. Where consumers, corporations, investors concerned about higher inflation was to return, consumption and saving patterns would change, requiring monetary action by the Fed and/or fiscal changes by the federal government. Let us now look at some of the components in the economy that can be controlled or influenced by policymakers, which can impact inflation, where they've been and where they stand now. Let's first look at this through the monetarist eyes and take a look at money supply. And for this example, we'll use M2. As you can see from slide 12, M2 grew steadily until the mid-1990s, when leverage began to take off through mortgage and asset-backed securitization and efforts to stimulate growth following the early 1990s recession. Money supply growth went parabolic in 2008 at the depth of the financial crisis following Lehman's collapse, and has been ramped up at even a faster pace in more recent years through QE 1 and 2. Is even more on the way through QE 2.5 or 3. Yesterday's FOMC minutes heightened expectations for more stimulus. So we have more than enough money in the system to potentially promote inflation, but it's not enough for money supply to be in the system. It has to find its way to work its way into the economy in order to fuel inflation. There's plenty of liquidity, but to put it simply, the pipes that providing that liquidity are clogged.
I think one of the things that's interesting to note there as we think about that, Mark, is how much emphasis there is increasingly put on the Fed's ability to, one, manage inflation and those expectations around it. And if you look at what's been done more recently, some of those policy moves, what it means as we look forward in terms of some of those things being, so to speak, unwound. For example, what you speak of is the amount of liquidity that's been pressed into the market.
Moving to our next slide, in order to free up the pipes, this is where velocity or turnover in the economy comes into play. M2 velocity, the number of times an M2 dollar is recirculated into the economy. The velocity of M2 confirms some of the spending patterns of corporations and consumers in the late 1970s and early 80s with ever higher expected inflation. Simply stated, why would a consumer save or a corporation put off spending in this environment when the dollar would buy significantly less in 12 months? Higher expected inflation feeds upon self-creating demand for goods due to the fear of loss in purchasing power. But look at the velocity of M2 during the 1990s through 2006-2007. Securitization sped the flow of money into the economy as car loans, credit cards, mortgages, music royalties, anything with a steady stream of cash flows was securitized at a faster and faster pace, plowing those funds back into the economy to be relent over and over again. Why did inflation not take off given the increase in money supply combined with record velocity? A number of factors have contributed to the inflation performance, including productivity globalization, which held down marginal costs as China and other emerging economies fed increased U.S. consumerism, while owner's equivalent rent pacified housing costs as measured by the CPI. It was the best of all worlds until the music stopped and suddenly, everyone realized that the game was over. Now M2 velocity sits at a multi-decade low as consumers deleverage and recapitalize and corporations sit on billions of reserves. So there's no inflation pressure yet. But one of the reasons why we look at history, look back at the history of inflation was to show that what happens when there is a global event. It can lead to unprecedented economic and market conditions leading to unprecedented policy actions. And with the recent financial crisis, this is no exception. One of the unprecedented events in the current environment is the growth in bank reserves held at the Federal Reserve. On this slide, data shows that we have some $1.6 trillion of reserve held by banks at the Federal Reserve, multiple times pre-crisis levels. Increased reserves were designed to aid the banks in dealing with liquidity needs and the fallout from souring loans and securities portfolios. But now these reserves sit on the Fed's balance sheet. The Fed was not allowed to pay interest on reserves before the financial crisis. However, in 2008, legislation was passed to allow interest to be paid, and the Fed now offers banks a modest 25 basis points on reserves. Not a bad return all in given where Treasury rates are. But what would happen to these reserves if the Fed followed the ECB's lead, which was to reduce rates paid on reserves to zero? What happens if banks begin lending again at a pace closer to pre-crisis levels? Does the rest of the world hold the capacity to provide low-cost goods to a refueled U.S. consumption trend? What about growing Chinese, Brazilian, and other emerging market consumption? Will the Fed remove the punch bowl in time? We won't know until it happens because there is no precedent. With that backdrop, I'm going to turn the presentation back over to Chandra, who will begin to discuss FlexShare's approach to hedging inflation. Chandra?
Great. Thank you, Mark. One of the things that we talk about a lot and we introduced in the beginning of the call is thinking about hedging inflation or managing inflation over distinct periods. One of the things I think is important to acknowledge as well, and we talk about this a lot, is certainly as we use CPI as a proxy and appreciation for how even the calculation has changed over time, and there's much debate even in the marketplace about sort of the precision of that. And I think that's something that we think about a lot. There are a lot of arguments, and I think some fair arguments that are made even with respect to that it might be understating what we see in terms of inflation. And so that's yet another reason why we think it's really important to think about inflation as we're managing a portfolio. Now, that being said, when we look at inflation, we look at these distinct periods of the short term, the intermediate term, and the long term. Certainly when we look over the short term, there is evidence of short-run volatility as it pertains to inflation. That is linked to a number of things, and certainly as we get to the latter part of the presentation and maybe in the Q&A, we can spend some time talking about the thought or the distinction of hedging kind of anticipated versus unanticipated inflation. But I think that's important to think about. The second period of time we think about is that intermediate term, and so for us the short term we think about in the context of 1 to 5 years. The intermediate term we think of the context of 5 to 20 years. One of the things that we use from a practical standpoint is thinking about investors managing certain objectives. So maybe a typical objective one might think about is someone who is putting away a portfolio, say that's saving towards their child's education. And so you could, in a sense, think about that as an example of something that will fall in the intermediate term. Finally, we think about the long term, and one of the things we'll do in the presentation is kind of give a look ahead to think about historically maybe what have been some ways to hedge inflation over the longer term, but also in looking ahead with some of the crosswinds that we see in the market, how that plays out in terms of thinking about those alternatives today. Despite much of what we see and all the hard work that is done by economists and market forecasters, the reality is the ability to really see inflation and predict inflation trends beyond 12 months has proven to be extraordinarily difficult. And we might argue, again, with some of the unique issues that we see in the marketplace today, while there are some things we can hearken to the past and look to, there are some things structurally and otherwise that might argue that in some respects this time it's a little bit different. So as we think about the short term, to be more specific, the things that we think about is the ability first of capturing unanticipated inflation, and this sort of gets to one of the things that we wanted to distinguish. We really think that, first of all, TIPS are actually a very good tool for looking at hedging inflation in the short term. First of all, given the duration or the nature of those securities, you're overlying a period where we have a higher degree of precision or ability to predict inflation, whether it's measured by CPI or whatever measure you prefer. One of the things that we've noted in our empirical research as well, and I'm sure others have seen, is that in the short term, inflation is greatly influenced by commodities. In particular, one of the things you observe in the marketplace is that short-term TIPS or short-duration TIPS are often even used as a proxy for crude oil. I think this also speaks to some of the things that can happen that cause unexpected or unintended shocks that might lead to unanticipated inflation. And so taking all these things together, we look at thinking about the distinguishment of, one, the period of time, looking at a short period of time, two, the ability to look at capturing specifically unanticipated inflation and laying out a premise that we believe TIPS are particularly useful in this particular context. That being said, and I'm going to turn it back over to Mark, what we also see is the correlation of TIPS to inflation certainly declines over time. And when you think about that being packaged in a fixed income instrument, as you go out longer and longer periods of time, duration has a much larger impact on the security. And so some of those things we think about long and hard as we think about the ability of TIPS to serve as an inflation hedge over longer periods of time. Mark?
Yeah, thanks, Chandran. Let's look at the short-term makeup of inflation, and with that, let's look at the contribution from commodities. In the current CPI index, commodities make up roughly a 40% weighting. The most commonly thought of in the items in the commodity space would be food and energy, which are removed from headline inflation in order to calculate core inflation. And it is core inflation that the Federal Reserve monitors, not the CPI, but through the PCE, the Personal Consumption Expenditures Index. However you measure it, core inflation is important in policy decisions, but for investors, corporations, consumers, we all live in the real world, which is headline CPI. So how do you hedge against short-term inflation? Well, obviously, a position in commodities would be a sensible suggestion. After all, they make up 40% of CPI. But what commodities do you hedge? Oil, natural gas, coal, unleaded gasoline, wheat, corn, soybean oil, cocoa, cotton, tin, nickel, aluminum, silver, and gold. The list goes on and on and on. With commodity futures, timing is critical. even if you can effectively hedge in the short term against commodity inflation from a multitude of different commodity sources, what about the other 60% of CPI? 31% of that is derived from shelter housing costs. How do you effectively hedge against owner's equivalent rent? Well, this is where TIPS come in. U.S. Treasury TIPS, first introduced in 1997, have become a major asset class used to address inflation concerns because of their construction designed to capture the monthly change in non-seasonally adjusted CPI. So what evidence is outstanding that TIPS have actually achieved this goal? Well, academic research on TIPS has covered several areas. In the area of timing, research has shown that by the time CPI is announced, TIPS have captured well over 98% of the changes in inflation as measured by CPI. Not only the commodity-based inflation, but housing and other factors as well. How about capturing commodity prices? Academic research has shown that TIP prices generally quickly incorporate commodity price changes into their prices, typically within 2 trading days. How about the change of oil prices and their outsized impact on short-term inflation expectations? TIPS are an effective hedge against this volatility, which can be demonstrated by looking at the correlation between TIPS break-even spreads and the price of oil. So first, let me define the term TIPS break-even spread. Break-even spreads are the theoretical level of inflation needed over a period of time for an investor to be indifferent between investing in a coupon treasury and the corresponding maturing TIP security. With that definition in mind, let's move to the next slide. On this slide, we have charted the price of West Texas Intermediate crude along with the 1-year TIPS break-even spread over the January 2011 through June 2012 timeframe. During this period, the world has seen the second stage of the Eurozone crisis occurring in the spring of 2011, the end of QE2 in June of that same year, the announcement, implementation of Operation Twist in the 3rd quarter, followed by the latest and very painful stage of the Eurozone crisis in the spring of 2012, plus the extension of Operation Twist to the year 2012 and year-end 2012, and increased expectations for QE3. Note the high correlation between the price of WTI and the 1-year break-even spreads. Short-duration TIPS quickly and effectively capture the oil price movements to account for the impact on CPI. As Chandran mentioned, TIPS traders have long used short-term TIPS securities as a proxy for oil, given the commodity's outsized impact on inflation expectations. But this is just one data series showing the short-term correlation of TIPS break-even spreads to the major contributor to short-term inflation. But what about intermediate inflation expectations? How have they behaved during this time period? Moving to slide 21. What we've done here is we have overlaid 10-year break-even spreads over the WTI and the 1-year TIPS break-even spreads. And as you can see, note some slight directional correlation between the 3 measures, but overall, for the 18-month period, 10-year inflation expectations as measured by the TIPS break-even spreads have ranged between 1.75% and 2.5%, comfortably within or below the Fed's targeted range of core inflation. So this is a good thing. Short-term TIPS correlations to short-term inflation, while longer TIPS correlate to the intermediate or long-term inflation expectations. But there's more to the story than this. As we've mentioned, the market's ability to forecast inflation is challenged, which plays an important role with TIPS. So we've talked about the TIPS break-even spreads and how this is a level of expected inflation an investor is hedging for the life of that TIP and how they quickly adapt to the market inflationary changes in the near term. However, evidence shows that the market, economists, and forecasters have poor visibility on inflation beyond 12 months. Why? Well, after all, TIPS are fixed income securities, and as a result, they possess interest rate risk. The return component of a TIP is made up of the return of the fixed coupon plus the accrual of changes in the monthly inflation over time. The longer the duration of a TIP, the greater the interest rate risk. This is just simply fixed income 101. Get the inflation forecast wrong and the fixed coupon duration becomes an even larger contributor to the total return of the TIP, which leads to TIPS returns being less correlated to inflation and more correlated to interest rates and to duration. The data on slide 24 shows the correlations between two fairly well-known TIPS indexes, the Barclays Capital 0 to 5 year and 10-year plus TIPS indexes. The evidence here is clear that correlations to inflation are highly influenced by the duration of the TIPS securities. Over time, the fixed coupon component can overwhelm the inflation component, with recent times being a prime example of that phenomenon, with long maturity TIPS posting outsized returns over the last several years due to the flattening of the yield curve and a relatively low inflationary environment. This concept is even more important than ever, as the current TIPS yield curve has negative real yields out past 15 years. The majority of your earnings on TIPS is coming from the inflation component. If the inflation comes in lower than current expectations, you've essentially guaranteed a negative return. So for all their benefits, TIPS have some challenges in hedging inflation, as do other asset classes. Historically viewed as inflation hedges have their challenges as well. Many asset classes long held as inflation hedges have not held up well to these expectations, as you'll see as we move on to the next slide.
And Mark, you know, it's interesting as we've worked on, you know, the research on this and talked to a lot of different investing clients. I think this has been some of the more insightful parts in terms of looking at the asset class correlations. And so, you know, I know you're going to get into it, but I think of what's of particular interest is, one, not only discerning which of the asset classes have shown more correlation to inflation and thus would suggest they would be more powerful hedges, but it's also interesting in some of the difference that we've seen over the different time periods when you look at that over 5 years and 10 years. And, you know, I'd love for you to share some of the perspective on what we've seen as we've not only done that research but engaged a lot of investors around this topic.
Yeah, and you'll see that trend in this data as we've seen the experience over the last 10 years in terms of increasing correlation between asset classes, and that trend has continued along with the inflation. This chart of asset class correlations represents some fairly well-known indexes with data presented on their 5-year and 10-year correlations of monthly returns to CPI. You can see from the data, many long-held beliefs of inflation-fighting assets haven't made the grade over the last decade. Specifically, TIPS and gold are in the bottom half of this group in terms of correlation with CPI. Well, why does this occur? Well, because in part their returns have been impacted by factors other than inflation, be it fiscal policy, interest rate, and currency fears. What does work well for hedging inflation in the 10-year time frame? Looking at the trends in data, commodities, and natural resource equities, those companies that own and produce natural resources and commodities show the most promise and are logical due to their contribution of commodities to long-term CPI. In summary, for the short term, we have shown you that there is some empirical data on TIPS effectiveness on the short-term inflation. TIPS have proven an effective hedge against unanticipated inflation in the near term through their ability to quickly incorporate changes in commodity prices and other contributors to CPI, including housing. However, for all their inflationary benefits, TIPS lose some of their effectiveness over time due to interest rate risk, so investors need to consider alternative asset classes for hedging intermediate and long-term inflation. With that in mind, let's turn to discussion on intermediate inflation hedging, that being the time frame from 5 to 20 years. On slide 28, taking some data from the previous slide, here we have highlighted the 5-year correlation of inflation and monthly returns for commodity futures and natural resources equities as represented by the Dow Jones UBS Commodity Index and the S&P Global Natural Resource Index. The Dow Jones UBS Index is made up of the near-term future contracts of 23 commodities, while the S&P Index represents roughly 100 global corporations in the energy, metals, and agriculture sectors. During the 5-year period ended June 2012, both indices demonstrate very positive correlations to the monthly returns to CPI changes, while commodity indexes have had a fairly stable record of correlation to inflation. Natural resource equities, as measured by the S&P Index and other more recently constructed natural resource equity indexes, have shown reasonable and increasing higher trends toward correlations to inflation. Some of the reasons behind this is the growing presence of new investors in commodity futures and natural resource equity markets. Investors can now challenge broad market benchmarks as a solution and address investing objectives, whether it be diversification, risk management, capital appreciation, or income. This trend has been aided and abetted by a new class of products introduced over the last 10 years. that have brought this new group of permanent investors into the commodity futures and natural resource equity spaces by delivering the ability to now invest in these market sectors in a more economic and transparent manner thanks to the development of multiple investment vehicles such as ETFs and ETNs. For global and natural resource equities, which historically are included in macro equity allocations and not viewed as a strategically allocated asset class directed towards inflation hedging, investors can now more effectively target natural resources exposure outside the core equity holdings. ETFs have also made it easier to provide market access to foreign ordinary shares of global natural resource companies benefiting from global growth and currency diversification. For investors, the simplicity of owning commodity futures in exchange-traded securities versus having to establish separately managed accounts for these positions is considered a major positive. So why looking to invest in natural resources? Well, beyond the natural inflation hedge from ownership of natural resources through companies that control hard assets, new investment products have streamlined the ability to target investments that own and develop in companies that own and develop commodities in rapidly growing emerging economies. Investments in foreign global companies and foreign local shares also diversify the portfolio away from the U.S. dollar and the risk of imported inflation through currency devaluation. Both natural resource equities and commodities via futures can offer benefits beyond inflation hedging, which we've listed here. Participation in global growth as a U.S. dollar hedge and a participation in the risk-on trade.
Mark, I was thinking about, obviously there's a lot of specifics around how it serves for the purposes of a currency hedge as well as the role that central banks play. But maybe this is an interesting opportunity to skip to kind of some of the thoughts and pairing it with our long-term views on inflation hedging.
Yeah, if we look ahead, and we can skip some of the data, and you can enjoy that at your leisure. If we move on to our concluding slide on slide 37, Chandra and I can discuss. This is where we're looking at, in terms of, for intermediate hedging, we look to global natural resource equities. As a natural inflation hedge, we favor equities over futures because of the transparency of the equities, the ease of investment, preferential tax treatment, and the less uncertainty over the regulatory and tax positioning going forward. There's little risk to the chance that major regulation will impact equity investing in either way. For long-term inflation hedging, and this is where we look at objectives where we look to private ownership of real estate and natural resources and effective hedges, long-lived assets, but despite the drawback of illiquidity, would include investments in timberland, mineral rights, and farmlands, along with real estate, residential, commercial, light industrial, public equity ownership of real estate via REITs, and infrastructure assets would also be considered. Obviously, with real estate, many issues need to be resolved, including the future of residential mortgage financing, all-important demand and the driver of ownership. But overall, U.S. real estate should benefit from continued population expansion, household formulation, and slow but eventual return to economic growth. Like public ownership, private ownership of natural resources should benefit from the demand in emerging markets, growing worldwide population, and expansion of the global middle class, including increasing consumerism, which, of course, will lead to future inflation.
I think the thing I would add to that is when we think about the long-term category, some of the things that we observe, particularly when we think about, say, equities and as well as natural resources, getting that through, say, private equity or private ownership in natural resources, because what that does bring into play is the ability to capture in the liquidity premium that would exist in any of those spaces. Now, obviously, that's going to come more into play when you have the ability to take advantage of time. But certainly in much of the research that you see and much of our own empirical research, there suggests that illiquidity premium, so to speak, is not only there, but it does persist over periods of time. The only other thing that I would note is thinking about where we've gone with respect to real estate in the most recent premiums period that we've been in suggests potentially some interesting opportunities as we look out over 10, 20, and 30 years, definitely in the 20-plus year category in terms of what role that will play in an investment portfolio, particularly with the correction that we've had in real estate assets, not just in the domestic markets in the U.S., but globally. The last thing I'd like to do before turning it over to Ali and hopefully to the broader audience for some engaged Q&A is just offer some parting thoughts. We package these in this way. The first one is what we'll call while you were sleeping, and sometimes while we're all sleeping. Certainly, the Federal Reserve, aided by certain environmental factors, some can suggest that they've done a reasonably effective job managing inflation. Again, I give the caveat that some of that maybe comes to how we measure the statistics. But that being said, when we look at a number of factors out there, certainly the growing interdependence among global economies, we think about what central banks have had to do collectively, we come to a premise that the prospects for unexpected inflation arguably are higher, and that gets to how do we manage that in a portfolio. So that's, again, why we're very keen to focus on inflation. It really is different this time. A lot of times, obviously, in our empirical research, we look to historical models to give us guidance in terms of how we might think about what's going on today, and that provides us some guidance for today. But again, first of all, there are significant demographic trends and shifts that are in place that will continue to characterize the global economies over the coming decades. That's leading to a number of things. One of the things that we see definitely is the volatility in asset prices. Clearly, there are unprecedented levels of liquidity that has had to be pumped in by central banks. Mark not only talked about that anecdotally in his comments, but he showed it in many of the statistics that we look at. From that standpoint, I think when we think about, one, the ability of central banks globally and collectively to really manage inflation, there certainly is more risk around that. And quite frankly, we can even look to periods historically and say that there is, with some consistency, the occurrence of overshooting that. And so we point that out as something to look at in a period of time where we think there are some things that could be distinctly different. Finally, when we look at this particular time that we're in, we characterize this last parting thought as the real McCoy. And so what we try and do is remind ourselves at the end of the day that the investors that we serve really have very real investment objectives that they're looking at. In the midst of what goes on day to day in the financial markets, and some of the pressing things that we look at, it's sometimes easy for those investors to lose sight of those objectives. But we remind ourselves that our investors have real objectives. They have to be met with real dollars. And so in that respect, we have to really focus on real returns in the impact of long-run inflation. With that, I want to thank all of the participants for your time and attention and listening to our prepared remarks, and I'd love to turn it back over to Ali, hopefully for some question and answers.
Thanks, Chandran, and thanks, Mark. There are quite a lot of audience questions, so I will keep mine to a minimum. I just wanted, before I get into the questions, I wanted to remind the audience that FlexShares has a number of ETFs in the space that's relevant to the subject of this webinar, specifically a 3-year target duration TIPS fund, which trades under the symbol TDTT, as in Thomas David, Thomas Thomas, and then a 5-year target duration TIPS fund, which trades under the symbol TDTF, F as in Frank. Those funds are gathering some serious assets, which is obviously germane to getting good execution if you are traveling in the ETF space. The first one, the 3-year, has almost $400 million last time I looked, and the 5-year has in excess of $225 million. And finally, there is what I consider to be quite an interesting security. I hope we can talk about it a little bit in greater detail. The FlexShares Morningstar Global Upstream Natural Resources Index Fund trades under the symbol GUNR. I presume you gentlemen will let me call it Gunner. I don't know if you guys favor that yourselves. In any case, that fund is rapidly closing in on $500 million. So clearly it's resonating, and I suspect the fact that it mixes developing and developed markets in that portfolio might have something to do with that. Enough about the ETFs. Question that I wanted to ask, and the single biggest fixed income ETF on the market now is the iShares fund TIP, which has just about $23 billion, quite a lot of money. And there are a number of other TIPS-related ETFs on the market. And my question is, for you, what is to recommend about your funds in a marketplace that is arguably already crowded?
Thanks for that, Ali. The thought process behind the two targeted duration TIPS portfolios was, and I'll try to keep this as brief as possible because I could go on for hours about this, but in order to compare a TIP security to a regular coupon-paying instrument, fixed income instrument, you need to calculate a modified adjusted duration for that TIP so you can put it on an apples-to-apples basis. Well, because of changing inflation expectations, the modified adjusted duration of those TIP securities changes over time. And so when you invest in a TIP security, you never quite know what your duration is going to be because of the changing inflation expectations of the marketplace. So as we mentioned in this presentation, because TIP securities have interest rate risk, when you're adding a TIPS allocation, you are either contributing or detracting from your interest rate duration positioning that you've done in your portfolio. And so the movement can be quite significant. And so, one of the things that we came up with, and this was built on our experience as a asset manager, was that we had been very effective in terms of managing active portfolios on to targeting duration. We worked with our partners at iBox to design an index that would capture a great portion of that active strategy in order to turn it into a passive replicable index for creation of an ETF. And so what we positioned the product for is that you get the benefits of the inflation hedge from TIP securities, but you have the certainty of knowing that your investment will carry either a 3-year in the case of TDTT or a 5-year modified adjusted duration in the case of TDTF. So it allows you to better control your interest rate risk and to use that interest rate risk in another portion or in the proper place in your portfolio, which is in the fixed income allocation, because we consider TIPS to be an alternative, solely inflation hedge and not part of your interest rate allocation. But you use that interest rate risk in your portfolio to where you're going to be better compensated for it, whether it be in the current market, say high yield securities, mortgages, investment grade corporates, emerging market bonds. Don't use that risk budget in your TIPS allocation, which is what you're guarding against inflation. Use it where you're going to be compensated. So that was the thought process behind those products.
Okay, great. I'll ask you another question, turn it and then move to participant questions, which, as I said, are numerous and incisive. The other question I wanted to talk about that Natural Resources Equities Fund, GUNR. It has an international composition, which is to say it is not only U.S. and outside the U.S., but also developing and developed. And I'm wondering if you might speak to, this is a rather granular question as it relates to ETF trading, but is there any concern there that there might be some divergence between net asset value and indicative net asset value to the extent that some of the securities in that portfolio they're trading at different hours than U.S. trading hours? You might not get great execution. If you could address that, the composition of the portfolio and that particular potential shortcoming. We've certainly seen that kind of issue creep up with international ETFs where you get bad execution because a stock market around on the other half of the world is closed while you're trying to trade an ETF here in the States.
Yeah, well, I'll let Mark begin in terms of the composition, and if need be, I'll add some thoughts on the execution. But go ahead, Mark.
Yeah, well, Ali, the portfolio obviously is global. We have exposure across the globe. I don't have the exact numbers in front of me, but the majority of the stocks held in this portfolio will trade in either European or North American and Central or South American time zones. So really the differential occurs, basically when the European markets close, say call it 10:30 Chicago time here, and issues. We do see some, pattern of behavior around trading volumes at the time. I would have to confer with some of our market makers to really get a better handle on it. But I don't think we've seen any material price swings, intraday or even, from day to day, unless there's been a significant news event, say in Europe over a long weekend, which happens to occur. But I think the portfolio is diversified enough, and while it does have exposure into, say, Asian economies and Asian stock exchanges, it's not significant enough where it has made so far yet to make for any trading problems.
Yeah, and the thing I would offer, Ali, because I think it's a very fair question that investors in ETFs think about, but it's not something that is germane to Gunnar, obviously, right? And so I think rightfully so, there are ways that the market makers reflect in their market-making capacity. Some of the vagaries of if you have different periods of time where securities markets are opened or closed. But what we do, as well as I'm sure many of the other sponsors do, is pay particularly close attention to that. And one of the things that we're akin to always remind investors of is looking at that in any perceived explicit or implicit costs in terms of the total cost of ownership for the product. And so we, one, do everything within our capabilities and work very closely to make sure the execution experience for investors is sound. And so to Mark's point, we haven't seen anything outside of the bounds which we would think are reasonable or comparing it to like securities. But we also do a good job in terms of positioning best practices and how to access that, as well as thinking about what are those costs relative to the period of time you want to own it and how it works in your portfolio.
Okay, great. I wanted to turn to the audience questions. There's one particularly incisive one drawing from something that Mr. Fama, the great luminary in the financial world, has often observed that T-bills are perhaps the best hedge for short-term inflation. So why not buy T-bills, and why is that particular chart absent when you were comparing West Texas Intermediate crude oil prices with the short-term tips and the longer-term tips? What about T-bills themselves as the best hedge for short-term inflation?
Well, I think part of the explanation goes into, one, you're basically talking about cash at that point, and cash in the face of inflation, both short-term and long-term, is a fairly poor store of value because you're obviously facing a decrease in purchasing power. But I think the current environment clearly demonstrates part of the problem, or one of the issues with it in terms of timing, which is right now we have central banks across the globe waging a war on real interest rates. So they've driven them completely negative in the interim. So if you're looking at investing in 3-month T-bills at 9-10 basis points right now versus the current inflationary environment, you've got central bankers anchoring the short end of the curve. You're earning nothing, yet you still have inflationary pressures feeding through the economy. So in the near term, you would be at a net disadvantage.
Okay. Now, we have another one related to the tips component of your presentation. This is a challenging, trenchant question. How can you argue for investing in tips over the next 5 years as an inflation hedge when they now guarantee you that you receive a real negative real return?
Well, that's the whole issue behind tips, is that you're earning right now, the bet is being placed on that inflation will come in at or above expectations. I mean, obviously there's mounting concerns that the Fed has basically, not explicitly, but it basically said that they are willing to tolerate higher inflation in order to promote economic growth. So they've targeted a 2% core PCE rate as their inflation target. What is allowable inflation? Is it 2.25? Is it 2.5? Is it 4? Right now, let's say the Treasury auctioned, reopened the 5-year tip security. I believe it came at a negative 1.25%, yet 5-year tips break-evens are about 193. So if someone can do the math in their head, you're getting about 68, 70 basis point return, as long as that inflation expectation holds true. So 193. Again, we go back to the Fed's ability to manage expectations, which has been, has been their goal ever since the Volcker Fed, was to manage the investors and consumers and corporations' inflation expectations, because they tend to feed upon themselves. So that is the crux of TIPS investing. If the inflation comes in at or above, you should be indifferent between holding a coupon treasury versus that TIP security. If the inflation comes in above the break even at the time of your purchase, you win as an investor. If it comes in below, you've actually lost versus, say, holding that coupon treasury. So while real yields on TIPS are negative out to 15 years right now, obviously the market is still concerned about inflation, and still the long-term trend in inflation expectations still hanging around that 2% level.
And Ali, I would just add, I actually do think it's a very insightful question, and it gets to why we make the articulation or the argument of how we think of inflation over different periods of time, in the short, the intermediate, and the long term. So underpinning that question is, one of the things that we've tried to call out, as you get longer out, we don't think TIPS situate themselves as being the best vehicle and or asset class for hedging inflation.
Right. Okay. Now, let me move to some slightly more broad-based questions. A couple of them. Do you at Northern Trust / FlexShares consider high inflation a likely scenario? And we have another question that is related to that, namely, what is the likelihood of an inflation shock, and what can you do if a bona fide inflation shock materializes? And to add a third one into the mix, can you draw the distinction between expected and unexpected inflation as it relates to preparing responsibly for future inflationary pressures?
Right. So a lot of questions there. Mark and I may be able to tag team some of them. Let me start out in terms of our expectations around inflation. So first of all, from a formal standpoint, and if you look at our projections from our economists, I would say we're largely more so in line with consensus. So we are not out in print or otherwise necessarily calling for large expectations around inflation. Our projection is somewhere in the neighborhood of 2.3% going out 5 years. Now, that being said, now this is more of a view that I think certainly I have, and something that we reflect in our thinking. When you line up all the issues that we're dealing with in the marketplace, while I don't put a number on it, my perspective and some of the things that we kick around in the group is that you have a much higher likelihood with the convergence of many things today to realize unexpected inflation. So if I were making an individual bet, and what we try and position people for is, we think that is a real likelihood or a real likely outcome. Well, why is that? Think about some of the things we talk about. It's just something as basic as the amount of liquidity that central banks have had to push into the overall economies, and then how do you unwind that? And again, I think we even have precedents in the past for saying that we historically have tended to overshoot that. Again, there I think is a very aggressive argument in the broad marketplace about how inflation is measured, and do we really have ourselves set up to really account for the inflation that's building in economy. So again, I could go through a number of things, but I would put the risk to the upside there. Now, for some of the other things, I'll pitch it over to Mark.
Yeah, Ali, one of the important things to think about is where the inflation pressure is coming from. If we have a geopolitical event, Israel strikes Iran over their nuclear program, obviously, what's the positioning there? You'd want to be long oil, you'd want to be long short tips in order to capture that. A little bit long, as long of odds of maybe that occurring is, for one day for Europe to wake up and to finally say, you know what, we're going to tackle our problems seriously, and all of a sudden, the one-way bet that's been going on in the marketplace in terms of lower global growth out of the Eurozone market and leading to lower global inflation because of them going through recessionary sessions, all of a sudden that bet's removed from the table. And we're now going to have a more optimistic framework around global growth. Well, there you'd want to be long equities, because obviously they're going to be beneficiaries of the fact that the developed economies are starting to get their acts together and to provide some clarity to feed the animal spirits not only in Europe but in the U.S. as well, which would obviously be a positive for global growth. And that's a good inflation, right? I mean, there's good inflation, there's bad inflation. So it really depends on where that could come from. And as we've talked about here, you've got to look at different time frames and different asset classes to attack each one of those kinds of inflation.
The last thing I would add, go ahead, Ali.
Let me just chime in. There are a number of questions related to the measurement of CPI, some of them polite and professorial, and some of them downright scandalized. But the question is, how can you might first educate the audience as to how it's been watered down since the days of Volcker, the measurement of inflation, and what's in CPI. You guys did speak to that a little bit, but you know, the more trenchant questions are, you know, how can you hang your hat and, you know, market securities that are based on what this particular question is characterized as a totally bogus measurement. How do you respond to that? That what you're targeting is something that is, in the worst case scenario here, fictitious in nature.
Yeah, well, we are dealing with government numbers here. So I mentioned the 1983 substitution of owner equivalent rent for housing prices, and obviously that played a major role in terms of keeping headline inflation down low during the run-up in the housing prices, and has actually held inflation or deflation up during the painful retrenching of the housing market. Don't quote me on this, but I believe the housing component of the CPI has still been printing positive numbers since January of 2010. So while we all know that housing prices have been coming down because housing rents have been going up, it's actually feeding through to a higher inflationary standpoint. One of the big things, I think, was the move to chain dollars, so that you now got the more and more of the substitution effect. You know, there was I always remember the speech by Bill Dudley about the iPad 2 and how much more power you were getting for an iPad 2 versus an iPad 1 for the same price. So that was actually deflationary. Well, that didn't help me when I went out and spent my $499 on an iPad, because that was an expenditure that my family wanted for that. So I was looking at inflationary pressures over, you know, my budget. So in terms of excuse me, of targeting the CPI, again, this is why we recommend the different asset classes, because investments in natural resource equities, the ones that, you know, the focus of Gunner really is on the upstream. So we, working with our partners at Morningstar there, we were really looking to identify companies that focus in on ownership and control of the production of the natural resources at the highest level of the supply chain, so that they would benefit the most from demand for and, say, periodic shortages of those commodities. And that's what feeds through to the bottom line of finished products, which then we see, you know, measured by CPI. But then again, you know, this is again why, you know, we have to, you know, for benchmarking standards, we have to find something to compare all products against, and unfortunately, like I mentioned, we play with the cards we're dealt, which is CPI.
Right, and I think that's an important point, Ali, because what we say is not so much that we quote-unquote hang our hat on that, but it is important in having this type of dialogue to have a common lexicon in which we can communicate, and certainly it gives us a directional indicator of the things that we're looking at, and I think that certainly we appreciate that, and the many very sophisticated investors on this call appreciate that as well. Okay, well,
that about wraps up our time. I want to thank Chandran Thomas and Mark Carlson from FlexShares / Northern Trust. And I want to thank you all for joining us for this Winning the War on Inflation webinar. I want to point out to you that the webinar will be available within 48 hours. And for those of you interested in the playback, please go to indexuniverse.com. Under webinars on the navigation bar on the top of the website homepage, and there is on-demand playback you will find once you do that pull-down menu. Again, I'm Ollie Ludwig, Managing Editor of indexuniverse.com, and I want to thank you all very much for attending. And again, Chandran and Mark, thank you as well. Have a good day, everybody.
Thank you.